How can I still contribute to my Roth IRA if I am over the income limit to make contributions? What if I made contributions in a previous year and accidentally was over the income limit and I'm just realizing it now? These are questions I'm running into all the time with clients and new clients, and just want to record an episode today on the art of the Backdoor Roth IRA. Just how it works, what it is, how to fix previous overcontributions if we've done that, and then how to conduct this each and every year. So let's get into it. Welcome. I'm Erik Baskin, an Air Force Academy graduate, turned veteran entrepreneur, and certified financial planner. I help military families and veteran business owners achieve financial freedom. So what is the Backdoor Roth IRA? Well, the Backdoor Roth IRA is a strategy of making a non-deductible contribution to a traditional IRA and then converting those non-deductible contributions over to a Roth IRA and not paying any tax on that whole transaction. So it is a strategy for high income earners, those that are over the thresholds for making contributions directly to a Roth IRA. Those phase out amounts in 2025 for single filers are $150,000 to $165,000. So starting at $150,000 is when we start running into problems. And then for those married filers, it is $236,000 to $246,000. So if you're over those amounts, you are not able to contribute directly to that Roth IRA. So what is available to us? The Backdoor Roth IRA. This isn't something that is specifically called that by Congress or anywhere in the IRS code, but it is completely 100% allowable. It isn't some shady under the table thing. The tax code currently does allow for this to be done, and totally legit, totally legally, each and every year for those high income earners. Doesn't matter if you're Elon Musk, you can do a Backdoor Roth IRA. Why does it matter? Why are we even talking about this? Well, Roth accounts are really valuable. They grow tax-free. Withdrawals are tax-free. There's no required minimum distributions. They're unbelievable wealth builders, especially if we can contribute to these in our 20s, 30s, and 40s and let them compound for decades and decades and decades. And maybe even this is money we're giving to our kids and grandkids. It's just an unbelievable vehicle to build wealth for you and your family. So we want to be able to take advantage of putting as much dollars into Roth accounts as possible. Okay, so how do we do a Backdoor Roth IRA? Great, we know what it is. How do we actually do it? Very, very simple, but you don't want to mess it up. And there are some caveats. So step by step, pretty simple. I would say 3 parts. So first, we're going to contribute $7,000 in 2025, $8,000 if we're over 50, and we can do that catch-up contribution of $1,000 to a traditional IRA. Ideally, this is an empty traditional IRA with $0 in it. We'll talk a little bit later about the IRS Pro-Rata rule and why we want no money in traditional IRAs before doing this. But let's just say we have a blank traditional IRA. We put $7,000 in it. I typically wait a day. You can look up online. Some people say, hey, you should wait a week or a month. Some people do it like the next minute. I typically wait a day just so the transactions are in different days and easier to track just for record keeping purposes. But I'll wait a day and then convert that $7,000 to a Roth. That can typically be done inside of whatever custodian or whatever financial institution that you're operating out of. You can usually transfer those assets directly from the traditional to the Roth. This is called a Roth conversion. So that's step 2. Step 3 is the proper reporting on this. So that would be filing for you, or if you're doing it in TurboTax or for your CPA, making sure this is reported as a non-deductible IRA contribution in a non-taxable conversion. How this is done is on Form 8606, which is telling the IRS we contributed after tax dollars to that traditional IRA. So we made a non-deductible contribution to that traditional IRA. We're not taking a tax deduction on that. And then we just converted those over. There is no tax on that conversion. So if we miss this step and we could do it, there's a couple things wrong you could do here. You could take a deduction on your traditional IRA. You're not allowed to do that if you're a high income earner. You're way over the phase out. The income limits are much lower than even the Roth IRA income limits. But what's more typically done is if you don't tell your accountant that you are converting non-deductible dollars from traditional to Roth, sometimes that can be coded as a taxable conversion, right? Because if we're converting pre-tax dollars to Roth, typically that's money that needs to be paid tax on this year on that conversion. But if it's a non-deductible traditional IRA contribution and we're converting that to Roth and we report it as such, we do not need to pay tax on that conversion. So very, very key record keeping and very, very key at tax filing to make sure that this is reported correctly. In my firm, I'm double, triple checking this each and every year because we're doing this for a lot of clients. Okay, I would say a key caveat, I mentioned it earlier, is the pro-rata rule. So if we have pre-tax money in traditional SEP, simple IRAs, the IRS treats all IRAs as one when we're talking about converting money from traditional to Roth. So this gets really messy, can create an unexpected tax bill for you, can be very difficult to track on Form 8606 each and every year. This is why I typically recommend we're only doing backdoor Roth IRAs when we have a blank slate, nothing in traditional IRA accounts at all. Just to give you an example, really simple. If I have $7,000 sitting in a traditional IRA, let's say I made that contribution way back when, maybe I rolled it over from a traditional 401k, whatever it may be. If I go and contribute my non-deductible $7,000, step one of the backdoor Roth process, I go and contribute that to that traditional IRA. I now have $14,000 sitting there. You may think that you can just go convert $7,000 over to your Roth, and what's the big deal? We just did the backdoor Roth IRA, just like you said earlier. The IRS says, no, hold on a second. You can't just peel off the $7,000 of the $14,000 that was non-deductible. We treat that account like every single dollar is split in half, right? So if we convert $7,000 over, the IRS is going to treat $3,500 of that $7,000 being part of our non-deductible contribution we just made today or yesterday. The other $3,500 is that pre-tax money from before and is taxable, right? So we thought we were doing a really easy, clean backdoor Roth IRA conversion, but now we've created a tax bill for ourselves of $3,500 added to our taxable income that we may or may not have planned for, may or may not be the right thing for us in this tax year. And we've now kind of gummed up our record keeping processes. So for this reason, I like to zero out traditional IRA balances. If they're really small, maybe you're converting all of that. You just got a couple grand. Maybe we're just doing the conversion, paying the tax before we even start the Roth IRA backdoor Roth IRA process. Maybe we're transferring some of that traditional, if we have a bigger traditional IRA balance, maybe we're rolling that to a 401k that we're currently working at. Maybe we're rolling that to a solo 401k because that is not an IRA. A traditional solo 401k, if we've got a side hustle, could hold those traditional dollars and allow us to have a zero balance in our IRAs to be able to do a clean backdoor Roth IRA. So just something to keep in mind. If you have those traditional dollars, we really want to be cognizant of that. Okay. Now let's talk about unwinding past mistakes. This is something I've run into quite a bit over the last couple of years with new clients coming on board that are kind of hitting those high income earning years the last couple of years. And they kind of just blew past that. Let's just say it's $236,000 for a married couple. They kind of just, 1 year they're making 150, then they're making 190, and then like all of a sudden they're making 290. And like they didn't even think about, they just had in Vanguard or whatever, like the auto contribution for the Roth IRAs. They didn't even think about stopping that. And they just blew past it. Like what can we do to fix that in hindsight? Well, if we're in the tax year still, if we're in, let's just say we made a contribution in 2025, we can recharacterize that contribution to a traditional IRA and then convert it to a Roth. That may or may not be easier than just taking the amount that you contributed plus the earnings out and then just contributing to a Roth. One thing we have to think about is the earnings basically on any contribution we're not allowed to make. So if we did $7,000 in January this year, it grew to $9,000. The earnings, that $2,000 is taxable. Even if I take the 7 out this year, then that $2,000, we kind of illegally made that money, quote unquote, and we do have to pay taxes on that come tax filing time. Now, if we're talking about a previous year contribution, here's how it works. So again, the contribution itself, we can remove a previous year. The earnings component is also taxable income, right? So it's the same as this year. However, now if we're talking about a 2024 contribution, we now have to take out an extra 6% penalty of the amount we contributed initially for every year that stays in. So let's do the math. If we contributed $7,000 last year, what is 6% of $7,000, right? That's $420 penalty for keeping that in for a year and not removing it by the tax filing deadline. So that tax filing deadline, right, is April 15th. For 2024, it was April 15th of this year. If I filed an extension, that tax filing deadline is October 15th, right? So just depending on if you filed an extension or not, it's by your specific tax filing deadline. If we don't remove it by then, we do owe that penalty to the IRS for every year that it's in there. So these can get costly over time. These can build up and be really messy. I can tell you from experience that the calculations on these are very messy and a little bit complex and are not fun. We do want to do things the right way though and fix it and then do things the proper way going forward with backdoor Roth IRAs that we've talked about on this episode. Be very careful when you're unwinding these and looking at this, probably talk to a tax preparer, a CPA, some sort of financial professional to make sure we're doing this the right way. Okay, so in closing, Backdoor Roth IRA, super powerful tool for high income earners that are over those income limits. Start worrying about this at 150 for modified adjusted gross income for single, and then those married filers at $236,000 of income. We want to know those phase out ranges. We want to be watching out for that pro-rata rule, making sure that we zero out our traditional IRA balances, make sure that we're fixing over contributions if we have done those in recent years, and then just taking those simple steps of making that contribution, making the conversion, and then recording that properly come tax filing time. Super important, probably the most important step in this process. I hope that this was helpful. Let me know if you have any questions, and we'll see you back here in a couple weeks. Thanks for being here. Appreciate it. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back with some more content to help you on your journey to financial freedom. See you then. This is a friendly reminder that the podcast is general and educational in nature and does not constitute tax, investment, legal, or financial advice with respect to any particular individual or taxpayer. Please consult with your own tax, legal, financial, and other advisors regarding your own unique situation.